Good afternoon, everyone, and welcome to today's class on installment sales. I see a few names in today's class, attendees that I do not recognize. If you are new to us, welcome, and if you're returning to us, thank you for coming back. Our class on installment sales is 1 hour long. Do stay tuned for 2 passwords that I'll be giving you during today's class. You need those so that you can take the password test to show that you participated in today's class. And we're just going to bounce over now to page 3 of the manual, where I begin with a course introduction. And when you sell an asset at a gain or a profit, the gain is usually taxable in the year of the sale. However, if the proceeds from the sale are paid over time in installments, the gain and the taxes owed are generally reported in years where payments from the sale are actually received. An installment sale is a sale of property where you receive at least one payment after the tax year of the sale. The installment sale rules, though, do not apply to the following: the regular sale of inventory, stock or securities traded on an established securities market, or the sale of property at a loss. And today's course is going to discuss the rules for calculating gains and reporting income under the installment method. Let's take a look now at the general rules. If a sale qualifies as an installment sale, the gain must be reported under the installment method unless you elect not to use the installment method or the property sold does not qualify for the installment method. Figuring your installment income. Well, each payment on an installment sale usually consists of the following 3 parts: interest income, return of your adjusted basis in the sale, and gain on the sale. And these 3 figures are really important, and how each is treated is very different. Interest income will, of course, be ordinary income, and typically you would report that on Schedule B and then carry it over to line 8 of your tax return. The return of your adjusted basis on the sale is not taxable at all. You don't include that part in your income. And then the gain on the sale is the profit or capital gain, and it's going to receive, in most cases, capital gain treatment that would carry over to line 13 of the tax return and be reported as capital gain income. Now, for each year that you receive a payment on the sale of your property, you must include the interest part in your income as well as the part that is your gain on the sale. But you do not include in income the part that is the return of your basis in the property. So let's talk a little bit about interest here. You must report interest as ordinary income, and interest is generally not included in a down payment. However, you normally would treat a part of each later payment as interest, even if it is not called interest in your agreement with the buyer. Return of basis and gain on the sale. The rest of each payment is treated as if it were made of 2 parts. So every payment is really comprised of 3 parts, but we look at one part being the interest part, and then the other part being the payment on the principal and what portion of that principal part of the loan is going to be taxable to you and what part is a return of your investment. So the rest of each payment is treated as if it were made of those 2 parts. One part is the tax-free return of your adjusted basis, and the other part is your gain. So how do you figure your gain on your payment, or the gain part of each payment? To figure what part of any payment is gain, multiply the payment minus interest by the gross profit percentage. And you use the following worksheet to figure the gross profit percentage. Now, one of the things that I've noticed on the Oregon consultant exam is they like to have you work on this gross profit percentage equation, and a lot of people have a problem with it, find it confusing and difficult, and it's probably not a wonder why. When you sit here and look at the worksheet, you spend half your time trying to understand what they mean by the contract price and the gross profit percentage, what is meant by that. And so I've taken this worksheet and I've actually broken out the words that appear on it that you really need to understand the definition of those in order to be able to do the worksheet. And also, if you're asked a question, say on an enrolled agent exam or on the Oregon consultant exam, to really be heading in the correct direction so you can select the correct answer on that test. So let's begin with selling price. The selling price is the total cost of property to the buyer. It includes any money, the fair market value of any property that you are to receive, any debt the buyer assumes or pays on the property sold, and any selling expenses that the buyer pays for the seller. The selling price does not include interest, whether it is stated or unstated. It could be that IRS will come along and deduce that interest was included in the selling price, and if it deduces that, it's going to subtract it out and reduce the selling price. Adjusted basis for installment sale purposes. This is the next line. So line 5A, this is your adjusted basis for installment sale purposes. What does that mean? Well, 3 items comprise installment sale basis. They include your adjusted basis, which is given a line up here, then the selling expenses and depreciation recapture. And so you can see here it says enter your adjusted basis, enter your selling expenses, enter any depreciation recapture, add these lines up, and that becomes your adjusted basis for installment sale purposes. Next, we move on to line 7 where it says enter the contract price, and let's figure what that is about. Your contract price equals the selling price minus mortgages, debts, and other liabilities assumed or taken by the buyer, plus the amount by which the mortgages, debts, and other liabilities assumed or taken by the buyer exceed your adjusted basis for installment sale purposes. And then finally, the very bottom line, divide line 6 by line 7, and this is your gross profit percentage. Well, your gross profit percentage is the amount of each payment that is to be reported as gain from the sale. The gross profit percentage generally remains the same for each payment you receive. However, if you agree to reduce the selling price at a later time, you will have to figure your gross profit percentage for the remaining payments. Now, this particular worksheet is used to figure your gross profit percentage, but ultimately, in the end, you spend most of your time with respect to an installment sale filling out Form 6252. So we're going to spend a good part of today's class looking at 6252 and going through some illustrations of how we make the computations and make line entries on that particular form. Form 6252, installment sale income, is used to report an installment sale in the year of the sale as well as to report payments received in later years. You attach it to your tax return each year that you receive payments. Form 6252 will help you determine the gross profit, the contract price, the gross profit percentage, and how each payment received during the year is going to be includable in your income. Form 6252 is divided into the following parts. In Part 1, you enter the gross profit and the contract price, and Part 1 is completed in the year of the sale. Part 2 is where you figure your installment sale income for the year. It is completed for the year of the sale and for any year that you receive a payment or are considered to have received a payment. And then Part 3 is completed if you sold the property to a related party. Reporting requirements for the year sale again. You would answer the questions at the beginning of the form and then complete Part 1 and Part 2. Line 3 of the form asks if you sold the property to a related party, and if you answer yes to the question on line 3, then you must also answer question number 4 and then complete Part 3. For years after the year of sale, you would answer the questions at the beginning of the form and then complete Part 2 for each year in which you receive a payment on the sale. Payments received, including payments considered to have been received. You must figure your gain each year on the payments you receive or are treated as receiving from an installment sale. These payments include the down payment and each later payment of principal on the buyer's debt to you. In certain situations, you are considered to have received a payment even though the buyer did not pay you directly. And this occurs if the buyer assumes or pays any of your debts. For example, mortgages or taxes owed, or pays any of your expenses, for example, sales commissions. When we're dealing with an installment sale, odds are that the reason you're working on an installment sale for your client is they've decided to sell a piece of real estate on the installment method. And there are benefits to a person who does it this way. For example, you could have a couple who has reached retirement age. They have a house that's fairly much free and clear, but they don't really want to live in that large house anymore. So they decide that they're going to sell it under a seller-financed mortgage. And what would the benefits of that be? Well, they can probably get a better interest rate there than they might get from other investments. But also, they're going to see a stream of income coming into them over time, some of which represents interest and some of which represents a tax-free return of their investment, and some of which, of course, is taxable. The third benefit is that if this house that they were selling would be, for some other reason, subjected to capital gain tax, it's going to reduce the impact of reporting that income. In other words, they'll be able to spread the income over a longer period of time other than realizing it all in the year of the sale. So seller-financed mortgages, the clients that I have that engage in those or have engaged in seller-financed mortgages seem to be quite happy with the option. I have one family who sold their principal residence on an installment sale. They also sold a beach house on installment sale, and then they sold a commercial building on installment sale. So they've got 3 different installment contracts going on at one time, and each year when I'm preparing their return, they're getting quite a bit more cash coming into them than is taxable income to them as a result of this particular deal. Under a seller-financed arrangement, how that income is going to be reported, one of the things to be aware of is that the interest component of each payment does get reported on Schedule B, and the special reporting procedures do apply if you finance a sale of your home to an individual, particularly if this is an individual who purchases the house as a personal residence. If it is purchased as a personal residence by the buyer and you are financing that loan, then you will need to report the income that you received that is interest income from the buyer. You report that on Schedule B, and in addition on Schedule B to entering the amount of interest they paid you, you will enter their name, address, and Social Security number. And in turn, that buyer, when they file their return, they're going to complete Schedule A, and on Schedule A they're going to put your name and address and Social Security number so that the IRS can tie those 2 amounts together, the interest that you're reporting versus the deduction that the new owner of the home is claiming. Next, let's move on to take a look at Schedule D. If your installment sale property was held long-term, you're going to enter the gain figured on Form 6252 onto Schedule D, line 11. And if your gain from the installment sale qualifies for long-term capital gain treatment for the year of sale, it will continue to qualify in later years as long-term capital gain income. Your gain is long-term if you owned the property for more than 1 year when you sold it. If you held your installment sale property short-term, enter the gain figured on Form 6252 onto Schedule D, line 4 instead. And here is a detailed illustration of how to complete Form 6252. We have a character named Sally Sale. She sold her vacation home on June 30, 2014 for $350,000, and she paid $5,000 in selling expenses. Sally purchased her home back on June 1st of 2004 for $150,000, and she claimed $2,000 of depreciation on that home in prior years. Sally received $18,000 in payments for the year of which $12,000 was applied to the principal amount of the loan, and $6,000 was applied to interest. Her W-2 is shown below. Go ahead and prepare her return. And we're throwing in a W-2 here because we need to show how the capital gain worksheet is going to figure the amount of tax she owes on the gain from this sale. And we've thrown in quite a bit, $8,000 of withholding for her. So to complete Sally's return, we're going to begin by completing Form 6252. We move over to the next page, page 8 of the manual, and on page 8 we've entered the required information. The name of the filer is Sally Sale. A description of the property is vacation house. We've entered the date acquired, the date sold, and to question number 3 we've answered no. So we leave line 4 blank. And because this is the year of the sale, we're now going to enter information in Part 1 of the form. And we begin on line 5 by entering the sales price, which was $350,000. No mortgages were assumed by the buyer of the property, so line 6 is blank. And then on line 8, we enter the cost or other basis she had in the property, which was $150,000. On line 9, we show the amount of depreciation she previously claimed on that house, and that was $2,000. So her adjusted basis is going to be $150,000 minus $2,000, or $148,000. And then on line 8, we enter the selling expenses that she had, which totaled $5,000. On line 13, we enter $153,000 as the sum total of her adjusted basis plus the selling expenses. Next, on line 14, we're going to subtract line 13 from line 5, and we do that. We get $197,000. That's her profit. And once we've figured the profit, now we can figure the gross profit percentage. And you can see line 18 is now being referred to as the contract price. The line 5 and line 18 in this case are the same number. Line 18 is the contract price. We're going to divide $197,000 by the contract price, and when we do that, we get a gross profit percentage of 56.286%. We're going to multiply that by the payments she received during the year, which totaled $12,000. And so $12,000 times 56.286% gives us $6,754 of income for the year. That is her capital gain income for the year. That is the amount that she's going to have to pay tax on. So we're going to carry that over to the Schedule D. And on the Schedule D, you can see we've entered that down on line 11. We carry it down to line 15, and then we go to page 2 of Schedule D and carry that $6,754 over to line 16. The next step is to break out the portion of the profit reported on line 16 that is a recapture or recovery of depreciation, and that's the $2,000. That $2,000 becomes relevant because it carries over to the capital gain worksheet, and it's going to be used to figure her net tax on the profit from the sale of this property. But before we get to figuring her tax, let's just take a look at the front page of her return. On page 1, we've entered her W-2 income of $50,000. We've also entered the interest income that she received, and because this is a seller-financed mortgage, we're going to have to complete Schedule B and enter the name of the buyer and the address and Social Security number of the buyer as well. So we've completed Schedule B and showing that Bob Buyer bought Sally Sales home, and we've carried that up then to line 8. Next, on line 13, we show the capital gain that is being reported for the year, and we arrive then at our adjusted gross income being $62,754. We move over to page 2 of the form. We claim her standard deduction. We claim a personal exemption to arrive at line 43, which is her taxable income. And once we've got the taxable income, now it's time to figure the tax. So we move over to the Schedule D tax worksheet, and the taxable income becomes the first line on that worksheet. Next, we have to determine what portion of this income is capital gain income. And the portion that's capital gain income gets subtracted out. So once we've reduced $52,000 by the $6,700, we end up with $45,850. $48,850 is subjected to ordinary income tax rates, and she goes to the tax tables and determines that the tax she owes on $48,850 is $7,325. And now she looks at the remaining amount of income for the year, that capital gain income. But that capital gain income has to get broken down into two numbers. There is the $2,000 that's the recovery of depreciation, and there's the $4,754 that is her long-term capital gain component. So we're going to first figure the tax on the capital gain, or on the recovery of depreciation. The maximum tax rate that can be imposed on that gain is 25%. And so we take 25% of $2,000, we get $500. And then the remaining gain, $4,754, is taxed at a maximum rate of 15%, and we get $713 when we do that computation. So the total tax that we're going to enter on Sally Sales return is $713 plus $500 plus $73.25. That equals $85.38. And that becomes the tax that is entered on her return. Ultimately, she has a little bit of under withholding, so she owes $538 for the year. And of course, this worksheet really does do a good job of explaining why the IRS wants to make sure that there is an interest component to all installment sales, because it would be very nice, wouldn't it, to have that $6,000 of interest income get treated as capital gain income and get taxed at the lower 15% rate rather than the higher ordinary rate. So the entire point of that rule on interest income is to make sure that that interest income is properly reported and included as ordinary income. All right, moving on to the next page of the manual. That was a situation with Sally Sale where there was no mortgage assumed by the buyer. It was just a direct sale and no mortgage component in there that we need to deal with. But what would happen if you sold a property on an installment sale and the buyer of that property agrees to assume the loan that you have on the property from you? Is there any way that that gets handled? And the answer is yes, there is a way that gets handled, so that's what we're going to cover now. You must figure your gain each year on payments you receive or are treated as receiving from an installment sale, and you are considered to have received a payment even though the buyer does not pay you directly, such as the buyer pays any of the seller's debts or pays an expense for the seller, for example, sales commission. However, the buyer's assumption of the seller's debt is treated as a recovery of basis rather than as a payment in many cases, but not all cases. So let's look at what happens when the buyer pays the seller's expenses. If the buyer pays any of your expenses related to the sale of your property, it is considered to be a payment to you in the year of sale. Include these expenses in selling and contract prices when figuring the gross profit percentage. If the buyer assumes your mortgage, or pays off your mortgage, or otherwise takes the property subject to the mortgage, then the following rules apply. Firstly, we have the rules that apply if the mortgage that they assume, that is, that the buyer assumes, is less than your basis in the property. So, for example, you own a property that has a basis to you of $100,000, and the mortgage that you have on it is $50,000. 50 is less than 100, and so this is the rule that would apply to you. The mortgage is less than the basis. If the buyer assumes a mortgage that is not more than your installment basis in the property, it is not considered to be a payment to you. It is considered to be a recovery of your basis. The contract price is the selling price minus the mortgage. And here we have an illustration where we're going to figure it all out. You sell property with an adjusted basis of $190,000. You have selling expenses of $10,000. The buyer assumes your existing mortgage of $150,000 and agrees to pay you $100,000 of cash, including a cash down payment and $20,000 in each of the next 4 years. Thus, the total sales price is the assumed mortgage plus the installment amounts and equals $250,000. Since the buyer is assuming your mortgage, you must include the assumed mortgage in the selling price of your property. The contract price of the sale is equal to the cash payments received of $100,000. However, you must reduce your basis in the property by the amount of mortgage assumed. So let's see how all of that comes together. We begin on line 5 by entering $250,000. That's the $100,000 of payments that you're going to be receiving for the sale of the property plus the value of the assumed loan, $150,000. That assumed loan gets taken right off again on line 6. So this is the amount of the mortgage that the buyer assumed. We enter that on line 6. We subtract line 6 from line 5, and we are left with $100,000. And this is the amount of cash payments that are going to be made by the buyer to the seller. Next, we enter the cost basis of the property sold, which is $190,000, and then we add in commissions and expenses of the sale that totaled $10,000. When we do that, we get a total adjusted basis amount of $200,000. We subtract $200,000 from $250,000 to get a profit of $50,000. But the contract price that we're dealing with is going to only be $100,000. And so this is a situation where the contract price and the selling price are actually two different numbers. And the gross profit ratio is based on the contract price. So in this case, we have 50 of profit divided by 100,000, and that gives us a gross profit ratio of 50%. And that means that if $20,000 of payments were received during the year, then the taxable part of that payment is going to be $10,000. So let's look at what happens in a similar situation, but this time the mortgage that is assumed is more than the seller's basis. If the buyer assumes a mortgage that is more than your installment sale basis in the property, you recover your entire basis. The part of the mortgage that is greater than your basis is treated as a payment in the year of the sale. To figure the contract price when the assumed mortgage is more than your basis, you subtract the mortgage from the selling price. This is the total amount other than interest that you will receive directly from the buyer. Add to this amount the payment that you are considered to have received, which is the difference between the mortgage and your installment sale basis, and then the contract price is the same as your gross profit from the sale. So here is an illustration of how that comes together. It's a little bit trickier to explain, so I actually put some explanations on this table, and you can see that the line colors correspond to line numbers on the form. So let's start at the top. The selling price for your property is $90,000. The buyer will pay you $10,000 annually plus 8% interest over the next 3 years and assume an existing mortgage of $60,000. Your adjusted basis in the property is $44,000. You have selling expenses of $6,000, which takes your total installment sale basis to $50,000. The part of the mortgage that is more than your installment sale basis is $10,000. So the mortgage being assumed is $60, your installment sale basis is $50. The difference between those two numbers is $10. This amount is included in the contract price and is treated as a payment received in the year of sale. The contract price is $40,000, calculated as follows. We first go to the selling price, which is listed at $90,000, and we enter that on line 5 of Form 6252. We then subtract out the mortgage that is being assumed, which is $60,000, and we enter that on line 6 of the form. And then we get a total, $30,000, which equals the amount that you're actually receiving in payments, and that's the amount that is entered on line 7 of the form. Next, we look at line 8 of the form, which shows the original cost basis. And to that, we add the commissions. So when we're finished figuring the basis, we end up with $50,000. So the mortgage assumed is $50. We subtract out the installment sale basis, and we've got mortgage in excess of basis equaling $10,000. And this $10,000 figure ends up getting carried down and is entered on line 17. We then add in any cash payment that was actually received for the year, which was $30,000. So the total payments being received for the year are $40,000. And ultimately what that means is that the gross profit percentage is 100%. And 100% of the payments received during the year are going to be taxable, as well as the difference in the between the basis and the mortgage, which is $10,000. So ultimately, it is treated as a total of $20,000 of payments have been received for the year, even though only $10,000 in cash was received for the year. So the $10,000 difference between the debt on the home and the mortgage on the home is income for the year, and the $10,000 of payments received for the year are considered to be income for the year. And therefore, the total income reported on 6252 is $20,000. So let's step this up even more, up another notch in terms of complexity. And now let's look at the sale of business use property, because in both these earlier illustrations, we were dealing with the sale of property that was not business property. It was sale of a home or a vacation home. But now we're going to look at what happens when we are selling business use property. An installment sale of property used for business or rent or for production of royalty income may result in a capital gain, an ordinary gain, or both. All or part of any gain from its disposition may be ordinary gain from depreciation recapture as well. And you're going to use Form 4797 to report these transactions and to determine the ordinary or capital gain or loss. Let's look first at the sale of business under the installment method. The installment sale of an entire business for one overall price under a single contract is not the sale of a single asset. Proceeds from the sale must be reasonably allocated to each asset that is included in the sales price. So how do you go about making allocations? How do you even know what they are? Well, to determine whether any of the gain on the sale of the business can be reported on the installment method, you must allocate the total selling price and the payments received in the year of sale between each of the following classes of assets. Assets sold at a loss, real and personal property eligible for the installment method, and real and personal property ineligible for the installment method, including inventory, dealer property, and stocks and securities. So if you sold an asset at a loss, you're not going to report that loss under the installment method. If you sold real or personal property that is eligible for the installment method, you would be able to apply the installment method to that. But you are not allowed to apply the installment method to the sale of assets that are not eligible for the installment method. And these assets for which you cannot claim the installment method are inventory, dealer property, and stocks and securities. So let's look at each of these in turn. Inventory. The sale of inventories of personal property cannot be reported under the installment method. All gain or loss on their sale must be reported in the year of sale, even if you receive the payment in later years. If the sales agreement does not specify how much of the selling price is for inventory and the other assets sold, then each payment must be allocated between the inventory and the other assets sold. You report the amount you receive or will receive on the sale of inventory items as ordinary income. And you do that such as if you were completing Schedule C, you sold assets owned by a sole proprietorship, then those ultimately would get figured into cost of goods sold on Schedule C. And if you were filing an S corporation or a partnership, you would ultimately do the same and get it into cost of goods sold. Residual method. Except for assets exchanged under the like-kind exchange rules, both the buyer and the seller of a business must use the residual method to allocate the sale price to each business asset that is sold. This method determines gain or loss from the transfer of each asset and the buyer's basis in the assets. The residual method must be used for any transfer of a group of assets that constitutes a trade or business and for which the buyer's basis is determined only by the amount paid for the assets. This applies to both direct and indirect transfers, such as the sale of a business or the sale of a partnership interest, in which the basis of the buyer's share of the partnership assets is adjusted for the amount paid under Section 743B. A group of assets constitutes a trade or business if goodwill or going concern value could, under any circumstances, attach to the assets, or if the use of the assets would constitute an active trade or business under Section 355. The residual method provides for the consideration to be reduced first by cash and general deposit accounts, including checking and savings accounts, but excluding certificates of deposit. And the consideration remaining after this reduction must then be allocated among the various business assets in a certain order. So we cover the sale of assets, the sale of business assets in another course I teach called Sale of Business Assets. In that class, we spend more time looking at Form 4797 and how to complete Form 8594. So today I'm not going to complete 8594 for you, but I'm going to at least review it, because if you are dealing with the installment sale of a business, you have to divide the sales price of that business into a valuation amount for each of the asset that transfers with that business. For example, you could sell a 7-Eleven franchise, right? What is that going to include? Well, it's going to include the franchise value. There's going to be an intangible asset in that franchise fee that was originally paid by the original owner, and now that franchise right is being transferred to the new owner. So that's an intangible asset that needs to be accounted for in the sales price. There's also the fact that 7-Eleven may have been sitting there for a while, and it's got, a workforce in place. It's got customers coming and going. It may have a certain level of goodwill that is tied to the operation of that existing 7-Eleven, and it obviously has goodwill that's attached from name recognition from the franchise. It's also going to have inventory on the shelves. It's going to have cash registers. It's going to have equipment and freezers. And if it's a 7-Eleven that has a gas station, some of them do, you're going to have tanks and a bunch of things outside. So if you're selling a 7-Eleven franchise, how do you figure out what part could be sold under the installment method? And the rule is that you have to break that 7-Eleven down into all of its component parts and treat each part as a separate sale item. And once you've determined what part of the value of the sale is going to be allocable to each part of property that is transferred, then you can determine whether that particular part of property is going to be eligible for the installment method. So, for example, all of the inventory that is held in that 7-Eleven store is not going to be eligible for the installment method, but the going concern value, the furniture and equipment, and other assets of a nature like that certainly could be eligible for the installment method. So, reporting requirement from Form 8594. Both the buyer and the seller involved in the sale of business assets must report to the IRS the allocation of the sales price among the Section 197 intangibles and the other business assets. You use Form 8594 Asset Acquisition Statement under Section 1060 to provide this information. Form 8594 must be attached to the tax returns of both the buyer and the seller. And it's helpful if the buyer and the seller agree ahead of time as to the allocation. But it's not that common, at least in my experience, that happens. Now, if a sale occurs of a business and attorneys are involved, and these attorneys are savvy to the existence of Form 8594, I have seen situations where the 8594 has been filled out for both parties at the time of the sale, and therefore it would be the same for both parties. But I've also run across situations where the assets have been sold and an installment sale is happening, and the parties have no prearranged agreement on what the valuations should be. Then are they going to get together afterwards and start agreeing on these things? It's possible that they will. It's possible that they're not speaking to each other. And so as tax professionals, we're left at the end trying to help the seller or the buyer. In this case, if we're doing an installment sale, we would be working with the seller to do the allocations correctly. So for asset acquisitions occurring after March 15, 2001, make the allocation among the following assets in proportion to, but not more than, their fair market value on the purchase date in the following order. Firstly, certificates of deposits, U.S. government securities. Any value that is assigned to those is considered first. You then move on to accounts receivable and other debt instruments. You then move on and look to see if there is property of a kind that would properly be included in inventory. And then you have all other assets except Section 197 intangibles. And actually this category that says all other assets is the category we very often see lots in there. That would be land, buildings, furniture, equipment, pretty much anything that you can see and touch that has been sold that is not a form of currency, right? And then we're left with the final two categories that have to do with Section 197 intangibles and goodwill. Those are divided into all Section 197 intangibles that are not goodwill or going concern value. So, for example, in the sale of a 7-Eleven franchise, we would have the inventory that should be classified into this Category 3. We would have the physical assets that would go into Category 4. We would have the franchise fee that would go into this Category 5, and then we'd have the goodwill and going concern value going into Category 6. Now, IRS says that if you have an asset that is described in 1 through 6 that can be included in more than one category, you should put it in the lower numbered category. For example, if an asset is described in both 4 and 6, you would include it in Category 4. Agreement. The buyer and the seller may enter into a written agreement as to the allocation of any consideration for the fair market value of any of these assets, and the agreement would then be binding on both parties unless the IRS determines that the amounts are not appropriate. Sale of partnership interest. A partner who sells a partnership interest at a gain may be able to report the sale under the installment method. The sale of a partnership interest is treated as the sale of a single capital asset. The part of any gain or loss from unrealized receivables or inventory items will be treated as ordinary income, and the term unrealized receivables includes depreciation recapture income. The gain allocated to the unrealized receivables and the inventory cannot be reported under the installment method, but the gain attributable to the other assets can be reported under the installment method. And for more information on the treatment of unrealized receivables, you can refer to IRS Publication 541. Let's talk about recapture of depreciation, because that's something that we really deal with in a very important way when we're looking at the sale of business assets. When we were looking at the sale of your home or the sale of personal property for which depreciation had been claimed, we just saw that that prior depreciation claim caused a reduction in basis and an increase in the profit. But when we're selling business use property, it gets a little bit more complicated, because with business use property, we have to determine whether we have a depreciation recapture for Section 1250 property or whether we have a depreciation recoveries for Section 1250 property. And depreciation recovery on 1245 versus 1250 property has very different treatment under the installment method. So let's look first at recapture of depreciation for Section 1245 property. Section 1245 property is property used in a trade or business for which depreciation was allowed or allowable in an earlier year. If you report the sale of property under the installment method, any depreciation recaptured under Section 1245 is taxable as ordinary income in the year of sale. This applies even if no payments are received in that year. If the gain is more than the depreciation recapture income, report the rest of the gain using the installment method rules. Recovery of Section 1250 property, though. Section 1250 property is real property or real estate that is used in a trade or business, and gain on the sale of Section 1250 property can generally be reported using the installment method, provided that the property was held more than 1 year and was depreciated using the straight line method. If the property was held for 1 year or less, then all gain is taxable as ordinary income. Well, to put these two different types of property into play for purpose of depreciation treatment and recapture or recovery treatment, we've got a nice illustration for you here. In this illustration, we have a character named Farmer Brown, and he has sold his farming business under an installment agreement. His adjusted basis in the land and buildings is $700,000 with accumulated depreciation of $80,000. Now, as a part of the sale, Farmer Brown also sells farm equipment with a basis of $100,000 and accumulated depreciation of $70,000. The sales price totals $1,080,000 and is allocated as follows: $1 million for the farm, land, and buildings, and $80,000 for the equipment. Now, the buyer's combined down payment and the installment principal payments to Farmer Brown totaled $40,000 for the year. We're going to figure Farmer Brown's taxable income for the year of the sale as follows. Firstly, we go over and figure out what part of the gain is 1250 gain. We have the farm sales price at $1 million, the farm basis was $700,000, and the prior depreciation claimed on the farm was $80,000, so the adjusted basis of the farm is $620,000. We subtract that from the sales price to get a gain of $380,000. That gain is divided into two components. The first component is the Section 1250 gain, which is $80,000, and then we have the long-term capital gain component of $300,000. Now we look to the farm equipment. That equipment sold for $80,000, and it had an initial basis of $100,000, but the prior depreciation claimed was $70,000. So we have an adjusted basis in the equipment of only $30,000. The sales price of $80,000 is certainly more than the adjusted basis, and so we end up with a gain of $50,000. But under the rules for installment sales, any part of the profit from the sale that is a result of a recapture of Section 1245 income has to be recognized in the year of sale, and the installment method would not apply to it. So even though Farmer Brown received only $40,000 of payments during the year, he must report $50,000 as ordinary income from the sale, because he must recapture all Section 1245 gain in the year of the sale, and no installment income will therefore be reported in the year of sale. So this is kind of an interesting scenario. We are looking here at page 2 of Form 4797. 4797 is one of those forms where you start on page 2. So we're looking at Part 3 on page 2 of Form 4797. You can see we've listed each of the assets sold, the date acquired, the date sold, and then we've broken down the two properties A and B, A being the sale of the farmland, $1 million. We show the original cost basis, we show the prior depreciation, we show the adjusted basis, and the overall gain. For the farm equipment, we show the appropriate figures, but we carry down onto line 25 to show that $50,000 of gain is going to be attributable to depreciation recapture. Add property columns A through D through line 24 right here. So we take 380 plus 50, and we enter that here, 430, and of that 430, 50 is for depreciation. So we move then on to page 1 of Form 4797, and you will see that we do not carry over any part of the gain on the real estate, because that's going to carry to 6252. Instead, we only show the portion of the gain that is from the recapture of depreciation on that Section 1245 equipment, and this number totaled $50,000 is going to carry over to line 14 of the 1040 return and get reported as income for Farmer Brown in the year of the sale. So let's look at what 6252 looks like for Farmer Brown in the year of the sale. He has an installment sale, so he needs to report the sale on Form 6252. He begins by entering his name, a description of the property sold, and then he goes on to Part 1 of the form, shows the sales price. He shows his cost or other basis in the property sold. He shows the depreciation that was allowed or allowable on line 9 as a reduction to basis. But then on line 12, he shows the amount of depreciation that is being recaptured on Form 4797, and that increases his basis back up to $700,000. $700,000 from the sales price of $1.08 million gives us a profit of $380,000. We're going to divide 380 by the sales price of $1,080,000, and we're left with a gross profit percentage of 0.35185. But ultimately, no income is reported under the installment method in the year of the sale, and the installment method would begin to apply in the next year. So on his 2015 return, he's going to fill out 6252, and by then he should be making some entries for payments received during the year. But for the year of sale, he has no installment income. He simply has recapture of depreciation income. Now, there's another level of complexity that can happen under the installment method, and that is that there is, of course, some risk to the seller. The seller might not have a good deal. Perhaps that buyer is going to default on the loan, and then they're going to have to repossess the property. So what happens if the seller has to repossess? If you repossess your property after making an installment sale, you must figure the following amounts: your gain or loss on the repossession and your basis in the repossessed property. Rules for figuring these amounts depend on which of the following three kinds of property you repossess: personal property, real property, or property that was your main home before the sale. The repossession rules apply in both of the following situations, whether or not title to the property was ever transferred to the buyer. Either you foreclose on the property or the buyer voluntarily surrenders the property to you. It is not a repossession, however, if the buyer puts the property up for sale and then you repurchase it. For the repossession rules to apply, the repossession must at least partially discharge or satisfy the buyer's installment obligation to you. The discharged obligation must be secured by the property you repossess, and the requirement is met if the property is auctioned off after you foreclose and you apply the installment obligation to your bid price at the auction. Reporting the repossession? Well, you report gain or loss from a repossession on the same form that you used to report the original sale. If you reported the sale on Form 4797, you will use it to report the gain or loss on the repossession. Figuring gain on repossession of real property. So we're first going to figure how we determine what the gain is on a repossession of property, and then we're going to look at how we figure our adjusted basis in that repossessed property. Your gain on repossession is the difference between the following amounts: the total payments received or that were considered to be received on the sale, and the total gain that you already reported as income. There is a limit on taxable gain. Taxable gain is limited to your gross profit on the original sale minus the sum of the following amounts: the gain on the sale you reported as income before the repossession and your repossession costs. Effectively, this method of figuring taxable gain treats all payments received on the sale as income, but limits your total taxable gain to the gross profit you originally expected from the sale. Well, to make sense of it all, we've got a couple of illustrations from you, and they actually come from IRS Publication 537. These are not ones I made up, but I've taken them and used them to figure some worksheets for you. You sold a tract of land on January 2012 for $25,000. You accepted a $5,000 down payment plus a $20,000 mortgage secured by the property and payable at a rate of $4,000 annually plus 9.5% interest. The payments began on January 1, 2013. Your adjusted basis in the property was $19,000, and you reported the transaction as an installment sale. Your selling expenses were $1,000, and you figure your gross profit as follows. Take the sales price, subtract out your adjusted basis, plus the selling expenses, so that you get a total profit from the sale of $5,000. For this sale, the contract price equals the selling price, $25,000, and the gross profit percentage is 20%. That's $5,000 divided by $25,000. In 2012, you included $1,000 in your income. If your gross profit percentage is 20%, 20% of $5,000 is $1,000. So in 2012, you include that $1,000 in your income. Then in 2013, you received $4,000 of payments with a gross profit percentage of 20%. That means you included $800 in your income in 2013. In 2014, the buyer defaults and you repossess the property. You paid $500 in legal fees to get the property back. Your gain from the repossession is figured as possible, and this is worksheet number D from the IRS instructions. We begin on line 1 by entering the total of all payments that were treated as received or actually were received before the repossession. So remember, in the year of sale, there was $5,000 of payments, and then in the year following the year of sale, there was another $4,000 of payments. So total payments received was $9,000. Then on line 2, you enter the gain that you already reported as income. Well, in the first year, we had a gross profit percentage giving us $1,000 of taxable income, and in the second year, 20% of the income equaled $800. So the total amount included in income for those earlier years is $1,800. So we're going to subtract $1,800 from $9,000 of total payments received, and we've got $7,200. The next step is to look at the gross profit on the original sale. Well, the gross profit from the original sale was $500, but we also now have to add in $500 as the costs of repossession. So we're going to add these costs of repossession to the amount already included in income, and when we do that, we get $2,300. We then subtract $2,300 from $5,000 to arrive at $2,700, and $2,700 is the amount that's going to need to be included in income as a result of the repossession. What would be the basis now in the new property, or in the repossessed property, rather? Your basis in the repossessed property is determined as of the date of repossession, and it is the sum of the following amounts: your adjusted basis in the installment obligation plus your repossession costs plus your taxable gain on the repossession. To figure your adjusted basis in the installment obligation at the time of the repossession, multiply the unpaid balance by the gross profit percentage, then subtract that amount from the unpaid balance. IRS says you can use the worksheet E from page 15 of IRS Publication 537 to determine the basis of the real property possessed. So we've gone ahead and done that. And we're going to continue with the previous illustration where you repossessed a tract of land, which had an original cost basis of $20,000 and a contract price of $25,000, which resulted in a $5,000 gain with a 20% gross profit percentage. At the time of the repossession, you had received $9,000 of payments, leaving the unpaid balance of the contract at $16,000. Your original cost of repossessing the property was $500, and your taxable gain on the repossession was $2,700. You can kind of tell here that we're going to get to $16,000 as the basis, but let's go through and do it anyway. You enter the unpaid balance on the installment obligation, $16,000, multiply that by 20%, and you get $3,200. Next, subtract line 3 from line 1, so $3,200 from line 16 is $12,800. Then add in the taxable gain that you paid on the repossession, add in the costs of repossessing the property, and you're right back at that $16,000, which becomes your cost basis in the property. So repossession of personal property, though, would be a little bit different than business property. If you repossess personal property, you may have a gain or a loss on the repossession, and in some cases you may also have a bad debt. To figure your gain or loss, subtract the total of your basis in the installment obligation and any repossession expenses you have from the fair market value of the property. If you receive anything from the buyer besides the repossessed property, add its value to the property's fair market value before you make that calculation. How you figure your basis in the installment obligation depends on whether or not you reported the original sale under the installment method. The method you use to report the original sale also affects the character of your gain or loss on the repossession. And if you want to learn more about repossession of personal property, refer to IRS Publication 537 and flip to page 12. And finally, we're going to finish up with a look at the sale of property to related persons. The following additional reporting requirements and restrictions apply if you sold property to a related person during the year. For the year of sale, complete lines 1 through 4 and parts 1, 2, and 3 of Form 6252. And for 2 years after the year of sale, complete lines 1 through 4, even if you did not receive a payment in those years, and also complete Part 2 for each year in which you receive a payment, and complete Part 3 unless you receive the final payment during the year. There are some disposition rules to bear in mind for sales to related parties. Generally, a special rule applies if you sell or exchange property to a related person under the installment method. This is referred to as the first disposition. You sell to a related party, that initial sale is called the first disposition. Then that person who is related to you who purchases that property sells it again, and that would be referred to as a second disposition. So there are special rules that apply if you sell under a first disposition to a related party, and then that related party makes a second disposition. And here are the rules. Generally, a special rule applies if you sell or exchange property to a related person under the following circumstances. Number 1, the related person makes the second disposition before making all payments on the first disposition, and the related person disposes of the property within 2 years of the first disposition. This rule does not apply if the property involved is marketable securities. Under this rule, you will treat part or all of the amount the related person realizes or the fair market value of the disposed property, if it is not sold or exchanged, from that second disposition as if you received it at the time of the second disposition. So in other words, if you sell to a related party and then that related party in turn sells, then you are going to be treated as having received income from that second sale. So that's what the rules here are about. And if you are dealing with a sale with related parties, refer to Publication 537 for more information on what to do. And the very final closing paragraph of today's course is what happens if you sell under an installment method but you don't want to report under the installment method. You could have an installment sale but not report under the installment method. And to do that, though, you would have to elect out of the installment method. If you elect not to use the installment method, you generally report the entire gain in the year of sale, even though you do not receive all sales proceeds in that year. How do you elect out? Well, if you make this election, you do not report the sale on 6252. Instead, you report the entire sale either on Schedule D or Form 4797, whichever applies. But you have to elect out typically on a timely filed return, including extensions. However, if you timely filed without making the election, you can amend within 6 months of the due date of the return. And on the amended return, write filed pursuant to Section 301.9100-2 at the top of the amended return. Now, once you make an election to not use the installment method, that election can only be revoked with IRS approval. So that concludes today's class on installment sales. Thanks for joining us. I promised you 2 passwords, but I've held them both out to the end, so let me give those to you. And then if you have any questions, we've got about 3 minutes left in the day. I'm happy to take those questions from you if you like. Now, at the back of the manual, you will see that there is a homework assignment. That homework assignment is optional for webcast and webinar students, but it is mandatory for self-paced students. We should have the answer key to it loaded into the LMS. If you're a self-paced student, you cannot access that answer key until you've completed the assignment. But if you are a webcast or a webinar student, you can simply just go access it. It's loaded in there for you. And it just gives you one more illustration of how to complete Form 6252 and the accompanying forms. It involves a character named Lois Lane who is selling a property to Clark Kent. So any questions, please feel free to ask them. Other than that, thank you for participating, and I hope to see you again soon. Bye-bye, everybody. Password number 1 is SWORD, S-W-O-R-D, SWORD. Password number 2 is Ghullam, G-O-L-L-U-M, Gollum. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.